the stage is yours.
Thank you so much. I'm going to stand a bit closer here. This works. Okay, so thank you so much for inviting me to present this work. It's the first session after lunch, so naturally they chose Macropru. I think it's the most exciting topic there is. I think that was a good choice because it's going to wake everybody up and be super excited about macroprudential regulation. So what we do in this paper, we look at how macroprudential regulation, whether macroprudential regulation can dampen these global financial shocks that emerging markets experience. So Laura has already talked about those. Gian Maria has already talked about those. We know that emerging markets, usually when financial conditions in the world are loose and buoyant, emerging markets experience very favorable credit conditions and in general very favorable economic output. And then when credit conditions tighten in the rest of the world, there are credit crunches as well. And we want to see what role Macropru can play in dampening these shocks to emerging markets. This is joint work with Francesco Grigoli, Nils Jakob Hansen, Damiano Sandri. It was started when Gian Maria was still assistant director and has benefited very greatly from his comments. And obviously, since he's my first boss, I have to say these are my views and not the IMF's or the BIS's. So I think in this room, I don't need to say very much that we know that global financial shocks, as I just said, can severely affect emerging markets. And if you would go according to strict macroeconomic theory, you would say that actually a free floating exchange rate, which Laura recommends when we just talked about Lebanon, should be able to offset all these shocks. But this is not true. We know that exchange rate flexibility alone appears to be insufficient, that also countries that have fully flexible exchange rate experience going with the global financial cycle and experience tightening when the global financial cycle tightens. So this has prompted and fueled repeated discussions about what additional tools, except for free floating exchange rate, can we deploy in emerging markets to keep them from these boom and busts. And the discussion has often concentrated on capital controls, and the IMF frequently reviews its stance on capital controls and how we should use them, But in this paper, we want to see what role macroprudential policy can do. And I'm going to show you now all the results, and then I'm going to rerun everything with capital controls and say how they compare to each other. But I really, in these 30 minutes that I have, I really want to concentrate on the Macropru. So this paper addresses really the three following issues. So first of all, can macroprudential measures, which I'm going to abbreviate from now on with MPMs, buffer the effects of global financial shocks on GDP growth in emerging markets? Then can macroprudential measures enhance monetary independence? So one way through which Macropru might actually help emerging markets to be a bit more isolated from the global financial cycle is monetary independence. And the third question is, are there any side effects of macroprudential measures, such as cross-country spillovers or effects on average growth? So let me just jump a bit. This is the only descriptive graph I'm going to show you, but show you a bit which shocks we're going to pose in our analysis and what we're talking about. So the first graph here on the top left, you see the US policy rate, which is the blue one, which is again the shadow rate that Lawrence asked about. So basically what we do here, as you can see, following Wuxia, we adjust for the QE and adjust for the zero lower bound. So the US rate is really our measure of the tightness of global financial conditions. Then we have a shock to the risk premium, which we're going to measure with the VIX, which is the red line here. And then we're going to have a shock to the supply of foreign capital, which we're going to measure by net capital inflows to the respective country. We're going to use an IV strategy here for endogeneity issues. But overall, you can see that there is a variation. But if we look now at the real GDP growth in emerging markets, you can already see that these co-move, that the global financial variables, capital flows to emerging markets, which is our supply of capital, then the risk, and the financial conditions, they co-move with the outcome with the real GDP in emerging markets. And what we now want to ask in this project, how can macroprudential policy dampen this connection between the global financial cycle and the real GDP growth. And for this, we actually look at this graph. It's the level of macroprudential regulation, and you might now ask, how do you measure the level of macroprudential regulation? And that's an excellent question. It's very hard, but the IMF has this data set. It's called the IMAP, the Integrated Macroprudential Policy Framework, and they actually ask every single country for every month, have you adapted the following policies? And there's 17 macroprudential policies, and the countries say yes or no if they have tightened or loosened each policy. And whenever they tighten a policy, we put a +1, and whenever they say they loosen the policy, we do -1. Obviously, there's a big caveat. I already see some people looking critical that there's no intensity. Somebody can tighten a policy by 5 percentage points or 10, but for us, it will still be a dummy of 1. So when we add these tightenings and loosenings, we get the average across our 38 emerging markets that we're looking at is here. So you see an upgoing trend, but you see also that after the global financial crisis, they've actually been loosened. So we see that while overall countries have increased macroprudential policies, EMs, this is our sample of 38 EMs, have increased macroprudential policy over the last 20 years, this is from 2000 to 2017, they do use them a bit cyclically and release them in a crisis. And you also see that here you see the 10th to 19th percentile. We do have quite some variation in the stance of macroprudential policy across our emerging markets, which makes it nice for us because we have a nice identification here because we see a lot of countries having different stances. So first question was, can macroprudential measures buffer the effects of global financial shocks on GDP growth? For this, we run the following regression. Yes, there's a question. Still on the data?
It's about the definition, actually. You seem to be using macroprudential and capital controls kind of interchangeably.
No, we have. Yeah.
Yeah. In this study, it's about data. What goes into your measurement of macroprudential?
So at the fund, we have a very strict definition, and we have 17 macroprudential measures and about 10 capital flow measures. Those are totally separate. How do we divide them? The answer is that macroprudential policy has the focus on domestic financial stability, whereas capital flows has the target to keep the BOP stable, and macropru only domestic financial stability. You are very right, we got this comment. There is one measure out of the 17 that I can argue with you because it's FX exposure. But we ask the country, are you doing the FX exposure because you're worried about domestic financial stability? Then it's a macropru. Or because you're worried about your BOP, then it's a capital flow. But that's only 1 out of 17, which I think you can put in both categories. The other ones are like LTV ratios, loan to value on a mortgage, loan to income on a mortgage. Service debt to income on a mortgage, CCYB for your banks. Those are the typical macropru. But actually, we redo all our analysis, excluding that 17th one that I think one can argue, and they're robust. But that's a good question. Yes?
One simple difference they look at is the residents versus non-resident. Anything
Yes.
that has residents or non-residents in it would be counted as a capital flows measurement tool, whereas anything that doesn't have that, it's a macroprudential.
That's exactly. That's one of the.
I like what you said earlier better, because when you're messing with residents' holdings of foreign currency,
Yeah.
we want to think of that as capital controls
Yes.
rather than macroprudential.
Yes, exactly. So that's also one of the criteria. Yes, probably the more determining. That's true. We're set on the data, so I'm gonna go on to my first specification, where basically I ask, as I said, so this is quarterly growth of real GDP, and then the 3 shocks that I told you that we have is the US rate, the VIX, and then we have net capital. We do outflows because we want the same signs, and we instrument following Blanchard and Obstfeld with capital flows to all other countries. So these are our shocks: the supply of global capital, the VIX as the risk-free rate, and the VIX as the risk premia, and we have these shocks. But what we really want to know is how can the effect of these shocks be dampened by macropru, by the level of macropru, and that's why here we interact the shock with the macroprudential measure. And just let me say one thing, because maybe it answers already your question. You should be very skeptical about identification here if I would put here the change in macroprudential, because GDP and the macroprudential measure you're taking today could actually be reversed, could actually have a reverse causality and could be endogenous. However, what I'm interacting with here is really the stance of macropru that you have when the shock hits. So this is what you've accumulated over the last 20 years. I can show you it's very sticky. And it's the level of regulation you have when the shock hits. It's not the change.
So one question, you control for the exchange rate somewhere?
So yes, so first of all, I have a...
Capital controls in general somewhere.
Yes. So in the end, in the paper, we have a horse race, we have both, we have everything. But for the 30 minutes today, I'm gonna focus on the macropru results. Actually, if we control for the capital controls, the macropru is gonna be significant and the capital controls not. And even if we only put the capital controls are still not significant.
So that I agree, but do you have the exchange rate somewhere?
So here we only take free floating. That's why we have 38.
This is a sample of only countries that free float.
Yes. And
38 emerging markets free float.
So we have let me look up exactly one of the Iletsky 1 to 11, which ones we actually ended up including. Okay, but we do have a country fixed effect included here.
Yeah,
and we do have the exact identification as a control variable. So the exact level of 1 to 11 in the control vector.
and then why do you go all the way to GDP and not?
We're going to do others as well. Yes, we're going to do credit growth and exchange rate.
Yeah, because I want to see the mechanism.
Yes. Yeah. Yes. Definitely. So, yeah.
Maybe I'm misunderstanding, but you seem to be focusing on the contemporaneous relationship between macroprudential regulation of time t and output
Yeah.
time t. But
It-
in principle, you think that, okay,
Yeah.
that's going to be...
So like that's why I was also, the
like
mechanism.
Yeah.
action today, and then it's in a few periods that you see the
Yeah.
benefits.
Yeah. So we do. Yeah, we do. This is super. This is a super good question, and we get this every time. In our robustness, we do 1 quarter lagged, we do 1 year lagged, and we go to the very extreme, and we even only take the long-term average for once, and the results still hold.
And then why are you so confident that there's no indigeneity issues in the sense that I might put the macroprudential regulation because I think there's a crisis coming? So that's going to tell me that output is going to fall on expectation in a few periods from now.
I mean, that would be okay, I think. I mean,
Okay.
but in a sense that you think that the GDP, your outlook on, so what you're saying is we should control for output
There's a bias.
expectations.
The regulation and because you expect perhaps a crisis coming.
Yeah, I mean, the problem is,
If
yeah.
you look at that, you may say, oh, then
Yeah.
regulation doesn't do anything, but that's because of the indigeneity.
No, actually, we find,
That and helps. Then bias, then
it's a down, yeah. So we find this to be super significant.
What you're describing.
The bias, yeah, so if
And
you
you're
find
saying
it,
my gamma might be negative, but you're going to probably report it.
Yes. Maybe I can go to the results and then, but one thing from you I take away, maybe yes, we could look at also expectations at some periods. So what I'm going to show now, as you can see here, what you can see here, this is what I'm going to show. So the interaction is what we're focusing on, but we're going to have the derivative here, which is the base effect plus the squared term. The squared term we include because there's a literature out there that says when you have very strong macroprudential regulation, it starts to leak, people start to circumvent it. So they suggest to include also the squared.
Ask the banks about that.
Yes.
That's basically what's going on.
Yeah, that's what's going on. We have many papers about that, so we rely on that and include the squared term and the base effect. So I want you to focus, for example, on this graph here, which is a response to a 10% increase in the VIX. So here you can see that as a function of the level of macropru. So you can see that at a very low level of macroprudential regulation, let's say 0, the effect of 10% VIX increase on GDP growth in the EM is very significantly negative. But if you move along and you can see that countries with much higher macroprudential regulation, see here it starts at around 15, at an index of around 15. Again, the index is the cumulative tightening. There you can see that the effect of the VIX on the emerging market is insignificant.
But I'm confused, how are you adding this if you're, so you don't have the regulation is making banks keep 2% of reserves. So it's not
For example, that's 1 out of the 17, yeah.
But how do you add the 17 quantitative measures?
So I just add the dummies. So every month they tell us at the fund that they have tightened or loosened. If they say we have tightened, I put a +1 for any of the 17. I put a +1. If they loosen, I put a -1. So this is our index. As I said, it's obviously not perfect because we don't have the intensity, but we know whenever somebody tightens or loosens. So this is actually the distribution of macroprudential regulations in emerging markets. You can see that most are here at around, for the whole sample, you can see that most are here around 15. Then here the red line is actually the last period because it's an increase. And you can see that the average is around between 15 and 20 that they have.
To understand what this 15-20 means, therefore
Yes.
you have a shock in VIX,
Yes.
and then what you have is people will tell you if they lose or...
No, so from a start, it's a cumulative index.
Yeah.
Sorry that I didn't explain this well. So this one is what I'm looking at. It's the level of macroprudential regulation. And this is starting in 1990, this is why you have. Starting in 1990, which we're pretty sure much before there was no much action in macropru. Starting in 1990, we ask every single country, whether they have tightened or loosened. And every time they say they've tightened, I put a +1 and loosened a -1. So basically, if you have tightened 3 times between 1990 and 2000, at 2000 you will have a +3. That's just your index. Don't interpret that. But it gives us a comparable index of the macroprudential stringency. Because what I cannot do is here at the identification put the change in macropru, because that's clearly endogenous. I mean, to change the macropru, whatever happening to GDP, that's clearly endogenous. But what's not endogenous, and I'm going to show that in all the robustness tests we do, is the level that you've accumulated over the last 20 years. That's not necessarily, endogenous to how the shock is affecting you today.
So you have to understand, but therefore when you say 15, it means that in the past you have done 15
Net tightenings.
or tightening.
Yeah.
Therefore,
Or you did 30 tightenings and 15
Yes,
loosenings. Yes. Exactly. That's what it means, but it's an index. It's
Sure.
if somebody has something better, I would love to have it. I would love to have it.
So the capital controls, when they had reserve requirements, which by the way is a very close cousin of macroprudential, they converted that into the equivalent interest rate, and that you can add.
Yes, no, I have actually 2 continuous variables, and I have a new paper where we have LTV actually in CCYB. We do have continuous variables.
But most of the
but
measures you can turn into some equivalent interest rate.
yeah,
And that you can add.
yeah. No, that is,
And then the level, you can compare across countries, because if not, like...
Yeah.
And I don't agree that before 2000 countries didn't have macroprudential.
No, 1990. That is why we here already have 1990, our data starts. Our sample starts here. But that's why we have here variation, right? Because the data actually starts in 1990, and that's why some are here.
If you go to Latin America in the 80s, there was 1 million credit controls. Credit for this, credit for that. It couldn't quantitatively go beyond these. Interest rates were fixed, like there were 1 million times.
Yeah. No, this is well taken. Unfortunately, our data starts there,
So, you have not included a time fixed effect.
No, but we do in the robustness, yes. And then you can only look, but what I really wanted to show you is this nice here, right? Where I have the base effect, and I can show you that the base effect is actually negative. And then once you go up and you have the countries that have a lot of macro-pru, then it becomes insignificant. But we do put a time fixed effects and only look at the interaction, yes.
Because what I mean, like the MPM, like for all the countries follow almost the same trend. So at the end of the day, what you're doing, like you're picking like a common trend across countries.
No, and we have a
with the time variation, and then like after the fixed effect of the country, you just kind of say that accruing less.
Yeah, and the trend is a problem. I agree with you, that the non-stationarity. But that's why we do this. Let's jump quickly to the to the robustness of this. So we saw that here in this chart. Otherwise, I'm never gonna finish. So basically, you see that at the low level of macropru, the VIX has a clearly significantly negative effect. But the more macropru you have in place, it becomes insignificant. And the same is for the outflows. It's not significant to the US rate, where we put a shock. By the way, this is a shock to the US rate, not the pure US rate, but also for the outflows. So you can see that starting at the specific level of macropru, this really dampens the global financial shocks to the country. We do a lot of robustness here. We do a lot of robustness that Javier is worried about, reverse causality. And we do a lot, I think the most important one is that we actually take the average regulation over time, which would also address your concern about the trend, and it still holds. So countries that just had on average a higher regulation over this time just fared better, no matter if they put it in response to another. And then you might be worried about omitted variables, and we put all the omitted variables that I could find in the international papers, from institutional quality, financial development, gross public debt in foreign currency, cyclical adjusted barren. We put a lot of omitted variables, and we try, and it does not affect our results. So some of you have already asked, is this driven by very specific macroprudential tools? Because we do have 17, and we made a big effort to put them into groups that are intuitive. We have tools that address capital, such as the CCYB, for example, that have credit demand, such as LTV, LTI, that have credit supply, such as a reserve requirement for mortgages, for example. FX exposure, those, again, we focus on the IMF definition, what is macropru, what is, and on liquidity. And we can really see that for the VIX, actually the credit demand, the FX exposure, and the liquidity is significant. And for the net outflows, it's the capital, the credit demand, and the credit supply. So we can discard the argument, well, maybe all your results are just driven by that one category that is FX exposure, because that's what it naturally addresses, the global financial flows. Then you might actually ask, is the effect symmetric? So are the macroprudential tools only dampening the negative shocks, which is what I mostly talk about when I tell the story, or are they also dampening the positive shocks, which, sometimes policymakers might not like putting macropru in place, because in good times it can also curb your credit growth, and the economy might actually want to enjoy high credit growth in good times. But as we all know, aside from this conference, there's no free lunch, and the macroprudential regulations actually dampens in both sides. So it also curbs GDP growth when global financial conditions are loose. So then Laura already asked, what could be the channels? I mean, this is a macro paper. We look across country. We unfortunately don't have very nice, in this setting, we didn't approach with using country-specific macro data, but we do look at some channels that could be, and we look at credit growth, nominal effective exchange rate, and real effective exchange rate. It depends on what you look at, but macroprudential regulation overall tends to dampen the effect of global financial shock also on other variables such as domestic credit, and here you can also see the exchange rate. So one channel actually that we want to focus on, because Laura already asked, what channel do you have in mind, is monetary independence. So according to the trilemma that we all know, actually countries with an open capital account, they should retain monetary independence if they have a flexible exchange rate. So basically, it should not, you should be able to set your domestic policy rate according to your goals of the mandate of the central bank and your domestic conditions. However, what we often see is that the US hikes, and we see this in this cycle again, and although the local conditions are not that great, the EM central bank hikes as well, right?
Latin America did it first. So
they did it first, exactly, but in anticipation. So the reason...
No, they did it first because they had inflation. It was not anticipation.
Exactly, they had inflation.
They increased the interest rate, and it worked.
Yes. So, but that would come in our regression fine, because they have a domestic inflation. What we're picking up in our identification is there's a lot of EMs that don't have inflation and nothing to do with their mandate, but they hike when the US hikes, and possibly to protect their currency, because if the US hikes, the US dollar appreciates.
That's the problem. They're not doing it for inflation targeting. They're doing it for another reason. reason.
Exactly. So
But it's a bad reason.
exactly. So what we're testing here is actually if a high level of macroprudential can make you monetarily more independent. Maybe countries with a high level of macroprudential regulations, by the hypothesis that they build a sounder financial system and they curb risk taking in the good times, they actually can act more independent. So we ran this regression, which is here the policy rate in the emerging market. So here we again have our shocks and we interact them with the macropru. And here we completely exclude for the pact. So here you can see the results. I plot again the same plot, so you can see that actually, I again put the derivative, the base effect, and the MPM. We can see that at a higher level of macroprudential regulation, allows for a more countercyclical monetary policy response. So as you can see, for example, this is a 1% point of the US hike, or if you want to go to the VIX increase, for example, if you have no macroprudential regulation, if the US hikes, controlling for your domestic, you're also going to hike. But if you have a higher index, a higher tightness of macroprudential regulation, it's actually insignificant. It's not clear whether you're going to hike. And if you have very high macroprudential regulation, you're actually able to go countercyclical with the US, which is according in the specification because we put the local exchange rate within your target.
So that's the part I didn't see. Where is the target, the inflation target?
So in this one, we exclude everyone that is not free floating, and so here we have the policy rate in the emerging market, and here we have the macroprudential shock and the usual shocks.
But shouldn't the test be that they were using their monetary policy?
Yes. So here we put the Taylor rule controls.
To target that.
Exactly, their own.
Claim they were targeting.
Yes. Exactly. So they claim here, that's what we put here. So, exactly. That's what we put here, and then we see how they react. And if controlling for their own target, if they still react positively to the US rate. And then we do, again, a lot of robustness in order to again address reverse causality and omitted variables, and the results remain robust.
I have a question. This macroprudential, is it current macroprudential or like maybe one lag?
Yeah, we do everything. We do a quarter lagged, we do a year lagged, and in this one I show the current. I also do the average over time, but in this one I show the current because it's a very sticky variable. And yeah, it's the accumulation of, if you look at 2015, it's the accumulation of macropru that you have since 1990.
For example, if you on the left-hand side, if you put the change in MPM instead of policy rate, would you also get something significant? Like, for example, maybe some countries respond by increasing MPM instead of increasing their policy rate, something like that.
And that one depending to the shock, you mean to a global financial shock? You mean they would loosen MPMs?
Or increase.
Yes.
I have a question
Yeah.
to Nicola.
I actually have a paper about that, and I want to send you.
Let the speaker speak. As she's running out of time.
Yes, I'm gonna. I have a paper with Christine Forbes exactly on that topic, so I wanna send it to you. I have exactly that. What determines the use of macropru, and whether countries do it when they find stress or a global shock or idiosyncratic domestic shocks. So last point I want to take because I'm running out of time is: are there side effects of macroprudential regulation? So far, we see a pretty positive story about macropru, right? So they can dampen these shocks when they come, and we feel like because EMs are exposed to big shocks, that's what the policymakers should do. But are there any side effects? Before we go out and advise these to countries, are there any side effects? And what are the effects actually on average growth? Because I told you before that there's no free lunch. Yes, they protect you from a slowdown, but they also curb growth in the good times. So what is the effect on average? What is the effect on volatility? EMs care about volatility. And what are the effects on other countries? So first, let me show how we evaluate the direct impact on average growth. So here we compare GDP growth outcome. We basically run the regression from before, and we project what if the country had been at the 75th or 25th percentile? We also did it with 80-20 and 90-10. It's robust, but here I'm going to show 25 to 75 percentile. And you can see here, so here you can see the time series, right? So the point estimate, and this is the 90th percent confidence interval, you could see that actually before the crisis, a country at the 75th percentile of Macropru would have actually seen significantly lower growth than the country at the 25th. So before, in the run-up to the crisis, the countries at the 75th percentile, controlling for everything else, have actually had lower growth. And this is what we said before, that Macropru also curbs growth in the good times. But then, when the bad times came, these countries that were at the 75th percentile had much higher GDP growth than the ones at the 25th percentile. So this is just a time series. So we run 2 regressions that can be seen here, and we can see that during 2000 to 2016, a higher level of macroprudential policies would, first of all, significantly curb volatility of GDP growth. So the one at the 75th percentile would have, if somebody were at the 75th percentile with the same country characteristics, would have a lot less volatility in GDP growth as if this country were at the 25th percentile. And we also find that there's not a significant effect on average GDP. So it really curbs growth in the good times, but it also dampens the shock. On average, it's insignificant what you have between 2000 and 2016. So this actually, for policymakers, should be a free lunch. You know, you get less volatility. Yes, you get less growth in the good times, but you also get a less severe contraction or negative effect on GDP growth when you have a global financial shock. And the last thing, the very last thing I'm going to show is there is a hypothesis out there that when one country puts very solid macroprudential regulation, the bad capital flows go to the other countries around them, because there's investors that say, well, I have this investment portfolio and I want to have a broad set of countries. So all of a sudden, one country puts all this regulation, and then you send the bad capital flows to the others. So basically what we're doing, we investigate these cross-country spillovers by extending the regression specification, and we put actually the macroprudential level of all the others in the regression. And we can see that actually if all the others around you have macroprudential regulation, most of this is insignificant, but if anything, there's positive effects if we compare with the same geographical region, within the same income class, and within the same risk class. So there's positive, actually, spillovers found. If all other countries around you have good macroprudential regulation, there's a significant positive impact also on your GDP growth. And I think I have to skip the conclusions because I'm out of time.
Thank you very much.
Sibande from the Dublin. Senior guy.
Okay, thank you, everyone. Yeah, I guess the debate is already on. A lot of the issues that I wanted to raise have already been raised. But I enjoyed reading the paper, and I particularly enjoyed the time they took to deal with all these issues that you've raised, particularly around indigeneity, around omitted variables as well. They have a very careful analysis of what the effects of the omitted variables would be on the results if they hadn't included them. So I think a lot of the concerns that you have might be addressed if you have a quick look at the paper. I think that gives a little bit of mileage to the results. So on. I won't summarize the paper since the debate is already there, so let me just add to the debate as well. First thing that struck me was the clear shift in the use of macroprudential policy tools by EMs. And then when I tried to collate that with the dependent measure, that cumulative responses, I found myself, is this not a function of the very fact that more countries are now aware of these tools and are using them? So is it a scaling effect that's affecting the results to suggest that there's more of an impact in the macroprudential policy than there should be? So I didn't have much of an answer from that. So maybe that's another discussion point that we could have. Another point that struck me is that conceptually this idea of symmetric effects is a bit difficult for me to understand, at least on a practical level. Why would, say, a positive shock have the same effect as a negative shock? That seems, and it's not very intuitive, given how we understand crises evolve. But that's probably the function of this averaging of the effects by the regressions, which suggests that, you know, on a net basis, this is somewhat. But I think if you were to put it in order of time, and you looked at how the effect was, this idea of symmetric effect, I struggle with it a little bit. So I thought that's another issue that we could. And there's also missing from the analysis, and it's not necessarily a critique on the paper, but there isn't much of a. So is this effect of this macroprudential policy a constancy? In other words, are there periods where we have crisis where these tools don't necessarily have the same level of effect as you would? The results suggest is quite strong in the. So I also struggle with that. That is this something that is constantly effective, because you only get this sort of cumulative effect of it, and it sort of hides a lot of these issues that are there as well. The reason why I say that is that at the bank recently we tried to look at some of these issues, and we struggled a lot with this. Really, what is an optimal mix when it comes to macroprudential policy? Because when you look at a lot of the literature, it seems to suggest that, of course, and they also do the same, it depends on initial conditions, but more importantly, it depends on the shock. So timing is quite an essential issue in that scenario, if we're trying to understand which tools are really effective at what point. And I thought the paper sort of skipped through those issues and didn't really look at those. We could also discuss some of those issues. And then this concept of a broad set of macroeconomic tools is a little bit difficult to understand in practical, because I imagine if we had a situation where we had to advise exactly which macroeconomic tools for which crisis, we would struggle. We would say it works, but when does it work? How does it work? Which tools are effective in which situations? In the South African case, you have a huge constraint on the fiscal side, which has had a significant impact on our risk premium. So I would be interested to understand and say, okay, in that type of situation, which macroeconomic tools are actually quite useful for us? We know broadly we're doing the right things. We do have financial stability. But if we're to move forward, then we need to really understand what reason. So I guess that then brings in this whole issue of the integrated policy framework that is being discussed currently, as to say how exactly which combinations of macroeconomic tools work the best in which situation. And those are the issues I think, at least from policymaker side, are more relevant and maybe would create more mileage in policy circles than just having this broad impact of effects. But I enjoyed reading the paper. I think it's certainly worth looking at. Definitely in industry, the idea of looking at macroprudential policy as a macroeconomic tool, not just a regulatory or a financial stability tool, is something I think in South Africa there's still a lot of growth needed to understand that effect. Because when we have our discussions or even how our institutions are structured, these two things tend to be quite separate. And I thought this paper really brought those issues together to say, no, this is actually a macroeconomic issue, and it's an important one on top of that. And financial stability is not a by the way or a banking issue, which is another perception that we often get in the bank. So thank you. I really enjoyed the paper.
I don't know exactly how to say this, but that results don't understate the benefits of Macropru. What I mean is that one of the purposes of it is, I think, to prevent disasters from happening. And I'm not sure that your data allows you to see that. And I have in mind, for example, in particular Mexico in 1994. Now, this was a very complex situation, but one feature of it was that the Mexicans had allowed their banking system to become sort of shaky and not good on reserves. The U.S. raises interest rates. Because the banking system was shaky, that would make it very costly for Mexico to raise the interest rate. So the macro, they were working on it actually, but had they had a better macro environment at that time, they might have been able to raise the interest rate and save themselves and everyone else a lot of trouble. I don't know if you can see that in your, if you get, do you have enough, do you have crises, like if you had crises in your data set and you were able to tell
So,
the cross section,
So we're not looking in 1994, but what I showed at the end, sorry I was a bit rushed, is exactly that. So I compare what happens to an individual country, whether it would have been at the 75th or the 25th percentile. And that's exactly what I compare. I can show you the individual country series, but on average what I find is, that they have lower volatility of GDP, and that on average the long-term GDP stays the same, but that they curb growth in the good times, but cut in the bad times.
You probably don't have crises in your data set.
From 2000 to 2016, I guess very local, very local.
So
I mean, the global financial
if anything,
crisis.
It's a little bit like thing. If anything, I think the macro is more effective, probably more effective than what you find.
Yeah, because I look at GDP growth and all, Yeah, maybe what I should look at extreme events, but
Just, what's a country that's 25 and what's a country that's 75?
I would have to look it up. I don't know by heart.
Yeah, I know there are a lot of robustness tests, that's suggesting one more. But in this case, I think what's important is you want to interact your global financial shock with different variables, right? Just having them in the levels, because you want to make sure that it's not these other things that you put in your controls that's really driving response to global financial shock. So in this sort of literature, it's kind of common to show controlling, interacting your shock with the control thing one at a time.
I want to commend you on work well done and well presented to begin with.
Thank you.
So this goes very much counter to my priors, and I appreciate being challenged on that. And I would have thought these things work to the extent that they regulated capital flows. So you're showing that essentially emerging markets function very much like advanced economies. Right? And making that capital stronger might be service to policymakers, because we talked a lot about these things in the global financial crisis when comparing Canada and the US, for example, where Canada was already instituting fairly decent macroprudential regulations, and their banks couldn't go as crazy, and it paid off handsomely for them during the crisis. And you're essentially saying that you need not be an advanced economy, you may as well do these things in any economy. And saying that out loud, I think, is a very useful policy lesson.
Thanks. And we do, your point is obviously was very good at the beginning. I mean, in the paper, if you read the paper, we do everything again with capital flow measures. And we also run a horse race and include them both. But it turns out that actually the Macropru measure is the one dampening the global financial shocks.
This is not something you're doing, but I want to encourage you to think
Yes.
about it. So one thing that people thought beginning 30 years ago why capital controls work is it forces the regulator to properly look at the banking system to implement the capital controls. And it may be that macroprudential regulations make them do this better, because they're not only looking at foreign currency transactions, but they have to keep an eye on domestic currency transactions too.
No, that could very well be, but that would be a welcome, actually, interpretation out of what we have. Yes.
So I have a quick reaction to Refet's. So I wonder if we can see that in the analysis, but is it possible that really the macroprudential policy measures are ultimately operating through capital flows? Can we be sure about that? I mean, if I put LTVs, okay, houses are going to borrow less, then maybe banks also issue less, less bonds abroad. So I don't think we can completely dismiss the idea that there is some channels by which, macropru is affecting capital flows. That's we can discuss more.
When she said they're already controlling for both capital flows and for capital controls, it depends on how well those controls are.
Okay. Then I have another comment. It's not a comment, not a question, but I like a lot the result that macroprudential policy measures help you have a more counter-cyclical monetary policy. But I wouldn't call that a test about monetary independence. I mean, the central banks are free. If they have a flexible exchange rate, they are free to choose their interest rate. So they are choosing to respond more or less depending on macroprudential measures.
Yeah, maybe that word is badly chosen. Yes.
I don't know.
Yeah.
They are free, but the Mexican example is an case.
No, but Mexico was fixed, no? At the time, Mexico was fixed exchange.
No, they're never independent.
Sorry.
Sorry, I was wondering about policy complementarity. I mean, you're controlling for capital controls and so on.
Yeah.
But I was wondering, maybe some of the macroprudential tightening or easing is done only because something else is eased or tightened. And you might not be able to capture that just by adding these controls, because at the end of the day, can you really say that because of the macroprudential measure, the effect on GDP growth was dampened, or because at the same time, something else was changed equivalently, because you accumulate, at least how I understand it, you have monthly changes in macroprudential measures, but then you run the regression at the quarterly level, right? Including the capital controls.
Yes.
Measure.
Yes.
Would there be like a way you could maybe have like a relative variable of relative cumulative changes in macroprudential policy relative to changes in capital controls and monetary policy, to sort of single out whether there was complementary forces of different...
No, we do have that in there. So we can tell a long story about this paper, but we used to have macropru, capital flow, monetary, and FX intervention in that paper because the broader project of the IPF came in, but there is a specification with all that. Not relative, that is a good idea, but we do control for the other things in one, yes.
So maybe relative
but not fiscal. So the comment on fiscal is well taken, but the integrated policy framework also, unfortunately, you won't find fiscal there. But apart from that, yeah, we tried to control. But the relative is a good point, yes. That we didn't do.
Clarification question. So you use the VIX as a proxy for financial shocks.
For the risk premia, yeah.
This is clearly endogenous to US growth, but global growth.
Yeah.
So as long as there's even a correlation between, let's say, the the macro regulation and how integrated is an economy to the rest of the world, then you would observe essentially propagation of global demand shock, a global growth shock, rather than the financial regulation. It could have nothing to do with macro.
Yeah.
That's an amazing pathetic point you make. That's why I wouldn't believe it.
I mean, yeah, we do assume that the VIX for an EM, I mean, we're always talking about the Mexicos and stuff, but there's also smaller EMs that we do believe that the VIX, is an exogenous shock to them. Of course, that could, I mean, we do have a country fixed effect in there that obviously not time varying, but kind of controls whether you're an open economy or not. And we try to address it that way. And also we have the share of debt in foreign currency. We have the trade balance in there. So we have a bunch of controls in there that we hope to pick this up. So that's definitely
Again, consistent with the message is a well-regulated financial system.
Yes.
Helps.
Yes.
I think we all agree.
Yes.
And I
That
think
is-
that's what
yeah.
Can't argue with that.
Well, once you put well, we...
But I think that's the part that like a little bit more detail would help.
Yeah.
What is it about it? And I would still like to see more the mechanisms, in part
Yeah.
because of the symmetry. Is it because you said there's some results in net credit, which for me would make more sense to make them more central? Because GDP is a mixture of too many things. So is this going because you dampen consumption, which then this is fine? Is this going because you dampen investment? Then it has to be hurting unless the investment was unsustainable or something. Is this dampening, just to go into a little bit more the mechanisms to, because if not the symmetry, I agree, it sounds kind of bizarre.
About that is spillover things, when you mentioned investment, this is from my early life as a central banker in New Zealand. One thing we observed following the introduction of the LTVs, one of the first things that was heard was housing supply. The residential investment collapsed. That led to further, the problems with the housing supply issue. The other thing we observed was the rents. Rents is something that, many people don't look at, but, if you push these people out of housing market, they go to rental market, and what happens there, kind of thing. The third thing is, I believe there is more evidence on, is the banks are able to shift lending to non-housing sector. There is a very good evidence from Turkey. In New Zealand, they just pump the credit to agricultural sector, as if we are shifting the problem from the housing sector to something else.
And the LTV is a good example, but it's obviously only one for symmetry. That in the case, for this again, like these are things that one needs microdata for. And I wrote a paper that is now in the JF about Ireland, and I had detailed credit registry on an LTV introduction. And because you said symmetry, we show in this paper, in the appendix, referee number 2 didn't like it, but we show that the Irish crisis actually wouldn't have happened in the real estate sector if we had a 70 LTV. Or 60, I think, was our simulation. If everybody would have only borrowed 60% of what their house was worth, then yes, we wouldn't have had that crazy growth that Ireland had, part of it, but we also wouldn't have had the crash because nobody would have been underwater if they would have only borrowed 60%. So this is one example of symmetry that I can tell you about the case of Ireland, because I had very detailed loan registry for the corporate sector. I had the security holdings. It's very hard to say cross-country, but I do take your point. And it itches me myself that I want to know more about the channels, about how is this propagating to GDP.
But like housing is one that people have a feeling that you can really get unsustainable bubbles, although, as you said, sometimes you kill that bubble and you create another problem. And that, if it's housing, I agree, that can be symmetry. Yeah. But if it's investment, it's hard for me to see the symmetry. If it's like business investment, capital production. So,
the theory, the hypothesis is what we have. I haven't looked at it, is that if you put your CCYB higher, or for example, one actually very often used is reserves that banks have to put aside for certain loans. If you crank that up, my hypothesis is that you give out less loans. And this is how you curb GDP growth in the good times when you put the regulation.
but it depends the type of loan.
Of course, but this is one out of the 17, so for the symmetry. I do take your point, and I actually like to hear that maybe my results are a lower bound. And maybe one thing to deal with that is to do more quantile regression style, where we look at extreme events and see if it's actually it's more successful in controlling the extremes.
It may well be, you can run logit type regression on a longer data set.
Yes.
And there may be,
yes,
not macro-proof, but like Mexico, you would have been able to see the Mexico banking system didn't have a lot of reserves in it. And so then your data set gets much bigger, I think. And then if you do logit, the probability of a crisis, you could ask, does macro-proof method, something like macro-proof reduce the probability of a crisis?
No, that is totally true. That is average. This project's limited to average GDP growth, but yeah, that's very interesting. And if I may just respond very quickly to the Discussant. I have until 3 now. Okay. So because I really want to thank. Where is he? I'm behind. I really want to thank you for reading the paper and for your thoughtful comments and your time. I mean, I think the symmetric effect we've talked about, I do think that many of these policies, you know, it's intuition that when this regulation is stronger, it's more costly. In all our models, you know, no, we put macro-pru as a cost, as a wedge, also capital flow measures, they're always a tax or a cost. I mean, if there's more cost, you do less business, and that's how it curbs economic activity in the good times. So that is on the effect. On the trend, maybe I didn't say this strongly enough. I agree with you, there is a trend, and people are using it more. But again, even if I use in the regression the average level of macro-pru throughout this period, I still find that the countries with the higher average level, so no worries about endogeneity dynamics, are less affected by the global financial shocks. To your question about policy advice, I think obviously we focus one at a time, and many people I think have been saying that already this is too macro, so I didn't want to throw in even more policies. For policy advice, I think the strong policy advice that comes out of this is that better regulated systems are less shock prone. And actually, we advise policymakers to take these regulations because in the long run, it doesn't decrease your growth. Yes, maybe in the short run, you might have less of an uphill, but in the long run, it doesn't, so you seriously should consider them. There's 17 of them. Which exactly? You can ask the IMF for technical assistance we do on macro-pru. This is an individual case, but the policy message out of this is really that on the average, you can see that macro-pru overall, over this sample of 38, obviously, it curbs volatility, it does not affect average growth, and it can help you in a crisis. And the individual tools are very country-specific. As we said, New Zealand and Turkey Ireland had this LTV problem. You know, if they would have been in place, then a lot of the crisis could have been avoided because their problem was the real estate sector. But in some other countries, it might be totally a different weakness that could expose, and then another tool would be better. So there is no one-for-all advice. And the integrated policy framework, as I said, the problem is we won't be able. Tatiana works on it, so maybe you should bother her in the break. But we won't be able to say much in comparison with fiscal. So there we mostly focus on monetary FX, macro-pru, and capital flow measures. Yeah.
The question I had: do you see any Basel III effects in your database?
So. Yeah, I mean, Basel III is a very long time, no? I mean, we've decided on it 15 years ago, still not obligatory. I mean, one by one, yes, if they tighten the countercyclical capital buffer, we would see that, yes. But most of the countries actually do an additional one. You know, they do an additional countercyclical.
Thank you very much.
Thank you.